This is an interesting view only because now the markets have seemed to have shaken off every single bit of the volatility that we saw just a little over a week and a half ago. Can we expect this kind of volatility to continue, given some of these mixed signals in the economy and from policymakers?
Well, aloha from Hawaii, Dom. So good to be here. We're forecasting continued volatility, and so unfortunately, I don't think we've seen the last of it. And a lot of that is attributable to a couple of things. One is that the consumer and the data behind the consumer remains really varied as far as their strength, and because the consumer is attributed to over 70% of our GDP, the consumer remains key to economic growth going forward. So I think we need to be prepared to anticipate some mixed bag of data, and the market will ebb and flow with that. In addition to that, we've come off of Q2. We're pretty much done with Q2 earnings, and they were relatively strong. Where we see some possible volatility in the future is with the forecast for the second half of 2024 earnings, and maybe some disappointment there. You're coming across some really different quarter over quarter and even year over year comparisons. So we're forecasting additional anticipated volatility.
Well, what we've gotten this week so far and what we'll get next week, and to a certain extent a little bit beyond that, is a big look at the intersection between the consumer and the markets, because it's retail earnings season. Walmart is coming up. We've already heard from Home Depot. What exactly have you seen in the early part of this retail earnings bonanza that has told you one way or the other whether the U.S. economy and the consumer are actually in decent shape or maybe not so?
So jobs remain, extremely important to consumer strength and the ability for the consumer to continue to spend. What we've seen in many of the reports have been big ticket items have been sluggish. So the high end portion of the product cycle, if you will, are tending to be a little bit weaker than expected. And at the same token, the lower side of the spectrum continues to be a little bit sluggish. This week is huge, as you said, with Walmart coming out with earnings. We'd like to see where their forecasts are. Less about what they've seen in the last quarter, but more about what they're anticipating going ahead.
All right. And then the part of the market right now that's got a lot of folks concerned is the mega cap technology side of things. Is that where you're finding value, or do you find more attractive other places to invest besides mega cap tech?
So we still like AI. We think AI is going to continue to be a disruptor and a place for growth going forward. And we would use market consolidations and pullbacks to lean into some of the better well-named companies. Always important in that is revenue growth and sales growth going forward. Additionally, their ability to fund and capitalize their growth into the future. But we're seeing areas of additional value in materials, and primarily in gold and really specific gold miners. You've had a pretty significant move in bullion, 10% in the first quarter year over year, another 20% second quarter year over year, where the miners haven't participated in the uptrend in bullion itself. And from what we're seeing in our research, there are many high quality miners that have really gotten operations under control. Balance sheets look better. Management is much stronger. And so we see some potential in that area as well.